Hey everyone, and welcome to This Explainer. We've got a lot to cover today, so let's just dive right in, because we are currently living in one of the most bizarre and completely contradictory economic environments in modern history. I mean, think about it. Right now, we are witnessing this massive, generational stock market rally, and it's happening at the exact same time that everyday consumers are feeling absolute peak financial pain. It's a complete paradox. So today, we're going to break down exactly what's happening, why it's happening, and most importantly, what you can actually take away from the whole shebang. It really begs the question, right? How is it even possible that asset prices across the board, whether we're talking about stocks, housing, or Bitcoin, are rapidly ballooning to these unimaginable levels while everyday people feel entirely left behind? Are we experiencing the start of a great melt-up where asset prices just inflate forever? Or are the cracks starting to form for a total economic meltdown? Because right now, it genuinely feels like we are living in two completely different realities. All right, let's kick things off with Section 1, the Great Market Disconnect between Wall Street and Main Street. There is a deeply uncomfortable truth about our current economy, and it's that Wall Street and Main Street are operating on two totally separate timelines. If you look on the left, the stock market is incredibly forward-looking. It literally only cares about what's going to happen 12 months from now. Future corporate earnings, trade resolutions, anticipated growth, things like that. But on the right, Main Street, consumer sentiment measures how people are feeling today. It tracks the harsh reality of today's grocery prices, today's oil prices, and your daily job security. So Wall Street is actively betting on tomorrow, while Main Street is just trying to survive today. And the true depth of that disconnect is honestly staggering. Consumer sentiment has actually hit its lowest point in the survey's entire 70-year history. Let that sink in for a second. 70 years. People are feeling the absolute maximum amount of economic pain, yet simultaneously the stock market is just setting nonstop records. I mean, the Nasdaq recently hit a 13-day win streak, which is its longest in 13 years. Now, historically speaking though, when consumer sentiment hits these historic lows, it's actually signaled a pretty strong time to invest. Why? Because the best prices are often found right at the point of maximum uncertainty. Moving right along to Section 2, oil's impact on inflation, the secret driver behind all this everyday pain. The really crucial thing to understand here is this rapid chain reaction. Oil doesn't just put gas in your car. It literally powers the cargo ships, the trucking routes, the factories, the packaging, the entire global supply chain that gets a product onto a shelf and into your hands. Just a few months ago, oil was trading around $57 a barrel. Well, recently, it surged to over $100. And when step 1 happens, steps 2 and 3 follow almost instantly. Costs spike across the board, and boom, inflation rises right along with it. Let's break down the actual math on this because it's pretty wild. For every single $10 increase in the price of crude oil, inflation gets bumped up by 0.2%, and overall economic growth gets set back by 0.1%. Because of this recent surge, we saw inflation stubbornly pop back up to 3.3%. And because inflation rose, the Federal Reserve essentially had to completely wipe any chance of interest rate cuts off the table for the entire year. The market went from cheering for multiple rate cuts to suddenly realizing the next cut might be years down the road. Let's shift gears a bit to Section 3, Bitcoin and housing trends, and look at how different assets are behaving in this environment. Now, if you've been tuning into the financial news lately, you probably heard this exact sentiment when Bitcoin recently dropped down to $60,000. This time, Bitcoin is actually done for. It's never going to come back. General market sentiment was incredibly pessimistic. People were declaring it dead in the water, assuming that even with the new institutional ETFs, it was heading straight to zero. But as we see time and time again in the financial world, the general consensus is frequently entirely wrong. Just look at the reality versus the expectation here. During a massive one-month rally where the S&P 500 jumped a staggering 12%, Bitcoin actually outpaced it, rising 13%. So what's going on? Well, massive institutional money is flowing in. The U.S. government is now the largest holder of Bitcoin. Major traditional financial institutions are launching their own crypto projects. And with the national debt constantly ballooning, investors are desperately looking for alternative assets to hedge their money. It just goes to show, doing the exact opposite of what the general crowd believes often works out. Now, contrast that wild ride with the housing market, which is incredibly fragmented right now. If we look at the regional disparities forecasted by Zillow, they're actually predicting a flat 0% growth nationally over the next 12 months. But look under the hood of that average, and massive shifts are happening. The West Coast, totally flat. The Sun Belt, places like Texas and Florida that saw those crazy, unsustainable run-ups recently, they're actually expected to see dropping prices. But then you look at the North and Northeast, where housing is relatively more affordable, and prices there are actually rising as buyers relocate just looking for better value. But look, the single biggest sticking point for housing, no matter where you live, is high mortgage rates. And those are directly tied back to those high oil and inflation numbers we were just talking about. Even if we look at highly optimistic estimates, mortgage rates might only fall to about 5.7% by the year 2030. To put that into perspective, mathematically, that decrease would only increase a homebuyer's purchasing power by about 5%. I mean, sure, it helps a little, but it is nowhere near enough to turn someone who can't afford a house today into a buyer tomorrow. Unless, they magically discover a rich, long-lost uncle. High borrowing costs are just keeping buyers frozen on the sidelines, which is finally forcing sellers to start negotiating. Okay, let's look ahead to Section 4, the Fed's next move, and the big leadership changes coming our way. We have a massive, looming leadership change at the Federal Reserve. Jerome Powell's term officially ends on May 15th. Shortly after that, Kevin Warsh is expected to transition into the role, kicking off a guaranteed 4-year term. And make no mistake, this transition is going to be absolutely pivotal for monetary policy moving forward, especially when we're dealing with such a fragile economic landscape. Now, the context of Warsh's expected appointment is really interesting. He was specifically nominated by Donald Trump, who historically favors lower interest rates. However, Warsh himself has publicly and repeatedly emphasized the principle of monetary policy independence. Basically, that's the principle that a central bank absolutely must make economic decisions without any political interference. He stated that acting in the nation's best interest requires unclouded, independent decision-making, signaling he intends to operate free of political pressure. On top of that, Warsh has openly discussed wanting to actually shrink the Fed's balance sheet, which essentially means pulling back on the money printing. And there's a pretty significant historical risk tied to this kind of transition. Just look at this number, -16%. Since 1930, whenever a new Fed chair takes office, the stock market sees an average decline of 16%. Add in the fact that Warsh wants to reduce the Fed's balance sheet right when the market is nearing dot-com era peak valuations, and well, it adds a major layer of historical uncertainty to the year ahead for sure. Which brings us to our final part today, Section 5, the ultimate investing strategy for surviving this chaos. Look, if there's one single thing you take away from this explainer today, is that trying to time the market is basically impossible. The market always seems to make you feel the absolute most confident right before it humbles you, and the most terrified right before a historic rally. The only proven, truly actionable defense against all this volatility is the consistency strategy. Decide on a set monthly amount to invest. Pick an asset allocation that you can mathematically and emotionally stomach, even if the market were to drop 50% tomorrow. And then just don't stop. Dollar cost averaging ignores the daily noise, it ignores the sensational headlines and the politics, and it focuses purely on long-term growth. So I want to leave you with a final, slightly provocative thought. As asset prices continue to melt up while the everyday consumer feels the squeeze, we really have to ask ourselves, are we setting up for the market to humble us all once again? Or is unyielding, robotic consistency truly the ultimate hedge against macroeconomic chaos? The data strongly suggests the latter, but as always, only time will tell. Thank you so much for joining me for this explainer. Keep learning, stay consistent out there, and I'll see you next time.